So I think we've hit some of a pivot point. We've gone from obviously aggressive tightening toward the Fed kind of running into somewhat of a liquidity wall, and now they have to balance financial stability with their attempts at fighting inflation. Um, and so I think that's kind of the big story in financial markets is this kind of pivot in liquidity. I think the challenge is that we're still in this kind of stall speed area. So a lot of economic indicators have decelerated without going negative. And so they're either mildly positive, roughly neutral, maybe in some cases mildly negative, um, and other ones are still pretty strong. And we have this kind of window here between now and the debt ceiling, where liquidity looks pretty flat overall. So the Federal Reserve was draining liquidity. Now it's kind of a messy situation. They're still, on one hand, they're pulling liquidity out with quantitative tightening, but then they're putting even more back in with loans. You have the Treasury General Account is still structurally drawing down its cash reserve as part of its extraordinary measures when it runs into its debt ceiling. And a lot of that's already behind it, but there is still some to go. And so as they draw that out, that goes out to the economy, and that's actually pro-liquidity. So you kind of have this multi-month window here where liquidity looks okay, but then the big challenge is that when they actually do get to the debt ceiling impasse, however that's resolved one way or another, when the Treasury actually then wants to refill its cash account and wants to, is able to issue debt again, that's a lot of new supply coming onto the market, and we're going to see how the Fed deals with that in terms of a liquidity response. And so overall, I would say we're kind of still in this multi-month period, but there's like storm clouds on the horizon. Um, and there's almost two economies, right? So obviously very interest rate sensitive sectors, which is things that are really reliant on debt or issuing tons of equity, ironically. So if you look at the real estate sector, obviously that employs tremendous amounts of debt, and therefore that's very interest rate sensitive. That's obviously been a point of concern both residentially and commercially. And then the other one is tech. And people don't often think of it as a real estate, as an interest rate sensitive sector, but it is because, especially in this past decade, so many tech companies have, in some cases, sold their equity better than they sold their products. And what I mean by that is they keep their prices low, they operate at a loss, and they make up for it by constantly selling new equity, both to their employees and to investors. And that's what allows the company to keep going. And that works as long as interest rates are like zero and people are willing to just keep monetizing that equity. But when there's actually a cost of capital, that equity gets valued very differently. It's no longer economical to keep issuing tons and tons of it. And then the company has to raise the prices to try to close the loss that they're making. And then that slows down their growth because some of their growth was only there because their products were underpriced. And then as their growth slows down, their equity valuations fall further. And you basically find out that a big percentage of that business was malinvestment, that there really was no there there. It was just a underpriced thing that wasn't getting its market signals due to manipulation. And so those are kind of the two sectors that are obviously most concerning. Whereas you don't really see much stress in the travel industry and the restaurant industry, in certain other parts of the real economy. There's kind of a bifurcated economy. Well, it's hundreds of billions of dollars. So that's the rough magnitude. I mean, basically, it was actually starting in the beginning of Q4 last year. For the first 3 quarters of 2022, liquidity was falling because the Fed was, doing quantitative tightening. And, that kind of culminated in the Treasury market was getting very liquid by the end of Q3. And then you also had the gilt market blew up. And you also had the dollar index kind of hit its peak. And that all kind of ended up around the late September period. And the Treasury General Account started drawing down more quickly at that point. And you actually, measures of domestic liquidity started trending sideways rather than down throughout Q4. And that kind of coincided with the dollar index coming off of its highs, the market coming off of its bottom. Treasury market liquidity still wasn't great, but it was no longer as bad as it was in that time. And so for kind of a multi-month period, we're in that sideways sort of trend. And that was in large part because the TGA was big enough to be offsetting some of the quantitative tightening. So that gives you an idea of magnitude. They drew it down from many hundreds of billions, and now it's below 300 billion. And so that was large enough to offset a significant percentage of quantitative tightening. Going forward, there's less than 300 billion left. It's still relevant on a scale. And when they get to a point where they want to refill it, I mean, their kind of baseline number for where they want it is around $500 billion. And so that's if they draw it down to roughly zero, down to the hour during the debt ceiling, and then they want to refill it, that's $500 billion that wants to get sucked out of the market into this like liquidity void. And so it's smaller than reverse repos, but it is a meaningful percentage of it, and especially when there's already liquidity issues in the system, it's certainly a meaningful variable. I think it's really concerning for Q3 or Q4. I think right now we're in a little bit of an eye of the storm, where, like I said, liquidity indicators look okay looking out a couple months, because you kind of have liquidity being taken out and other liquidity being put in. And the question is, when you get towards the later part of this year, when a lot of these things all coincide to kind of be bad for liquidity and bad for growth, I think that's where storm clouds hit. And how concerned to be partially comes down to how you think people are going to navigate it, right? Because this is an actively managed system, and a lot of it will come down to human decisions. And there's ways to cause a massive liquidity shock, and there's also ways to just kind of like flood it with liquidity, and kind of weaken on the inflation fighting front. And so I think it'll be pretty pivotal decisions by the Fed. I think an instructive period to be familiar with is the repo rate spike of 2019. That was the last time that quantitative tightening ended. The Fed was drawing down their balance sheet in 2018, 2019. And they did so until September 2019, when they caused the repo rate between banks to blow out. And the Fed had to come in and participate in the repo market. But there are a number of us at the time that were pointing out that they were basically, the system was being flooded with T-bills, and the Fed was going to have to start buying some T-bills. And about 3 weeks later, that's what they had to do. And I think we're kind of in a similar environment now, where right now they're still trying to be tight with their actual balance sheet, but then they're offsetting it by loans. And I think they're going to find a time later this year where they're unable to keep doing quantitative tightening. It doesn't mean that they necessarily turn to QE right away, but I do think that at least on one of those liquidity fronts, that quantitative tightening portion, I think that's likely to stop, because there's not much else liquidity that can come from the system. And I think that's the thing that I think they overall kind of basically overestimated how much liquidity is in the system.